Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at State Street's US equity sector rotation ETF portfolio. Now, State Street is simply trying to tactically allocate to sectors in order to outperform the benchmark, which is the S&P 500. So let's investigate in terms of how successful State Street has been with sector rotation models. A quick look at the holdings shows that this portfolio is comprised of 6 ETFs that are all from State Street, a little bit of cash, and that the largest weights are in technology with 41%, followed by communication services with 23%, and healthcare with 16%. We also see, the first thing that we see that kind of like isn't that great about this portfolio is that there is a 0.3% allocation to industrial stocks. Now, such a small allocation has no relevance for the total return, and that should be simply sold or moved into cash. Now, having a quick look at fees, now that's more on the positive side because this portfolio is cheap with 8 basis points because State Street ETFs are just very inexpensive. We can look at the performance of the current holdings and do see that since 2020, this portfolio would have outperformed the S&P 500. So from a first glance, this is great, right? And kudos to State Street. Having said that, this is just the current holdings, and State Street, like most investors, right, does what's kind of natural, which means to put in the better performing funds in its portfolios, which is healthcare and technology, right, in this case, right? And it's performance chasing effectively. And we can demonstrate that because we can look at the actual track record of this portfolio by going to the fact sheet. And so here we do see the performance of the portfolio with changes in allocations, right? And, sector rotation going on. And effectively, the return since inception in 2020 was 12.18 versus the performance of the benchmark, which is the S&P 500, of 15.47. And that simply highlights that State Street hasn't been creating value with equity sector rotation. They've rather been destroying it. Now, let's investigate in the sense of if we can learn anything in terms of why that has happened, right? And by comparing this current portfolio to its benchmark, we do see that it's comprised of equities, like the S&P 500, of course. We do see it's almost exclusively US exposure and large caps. If we move on to sectors, we do see that there are significant overweights and underweights. So the overweights are to technology and to healthcare. And the underweights are to, well, pretty much everything else. Now, as mentioned, these overweights, these large overweights to health and technology stocks, that kind of indicates this performance chasing because pretty much anyone has seen that healthcare with all that enthusiasm for GLP-1 drugs like Ozempic, right? And the technology sector, of course, right? That this has been some of the better performing sectors, right? And so having overweights to that, well, that indicates a hindsight bias, a little bit performance chasing. We can change the perspective from sectors to factors and can see that there were some structural biases of the current portfolio. For example, we can see a positive exposure to the quality factor. We can also see negative exposure to the value factor. And that's kind of expected. If you have a portfolio comprised of, I don't know, as an overweight to technology stocks and healthcare, that tends to be highly profitable, but also expensive stocks. Having said this, we do see that if we look at how much have equity factors contribute to the risk of this portfolio, it's been almost zero. And so the primary risk of this portfolio is simply the stock market. There is, however, also something else going on. So what State Street is doing is they are combining sectors that have factors that are offsetting each other. So for example, we can see that the betas of the momentum factor, that there is a negative beta from communication services stocks. We can see there's a negative beta from healthcare, but we can see there's a positive beta from consumer staples and also down here from industrials. So effectively, if you combine negative betas with positive betas, you end up with very low betas. So that means effectively you're back at clear vanilla equity. And so this portfolio doesn't have a particular clear focus from a factor perspective. Is not thoughtfully constructed. It would be better to remove any like opposing factor exposures and give it a clearer focus, right? So that at least you know what you're betting on, because like this, you're betting on nothing except the stock market. The good news about this portfolio is that, as mentioned, it's cheap with 8 basis points, so there's no point trying to reduce fees, right? Having said that, we can evaluate if we can simplify this portfolio. And indeed we can. We can go from 7 securities to 2. And that simply means, a portfolio comprised of the S&P 500 and the QQQ, which is a Nasdaq. And this portfolio, the simplified portfolio, would have been slightly higher from a cost perspective, 12 basis points, but from between 12 basis points and 8 basis points, this is marginal, and this does make a difference. This is much more than the daily volatility. So this kind of concludes our short analysis of State Street's US equity sector rotation ETF portfolio. As we've seen that unfortunately the equity sector rotation model hasn't worked. The portfolio has underperformed its benchmark by 3% since inception. It's cheap, but you can also simplify it into just 2 securities. Hope that helps. Have a nice day.